On Canberra Live with Leon Delaney. Money Matters with Luke Smith from Envision Financial Services.
Yes, it's time to talk all things finance once again with Luke Smith from Envision Financial. Good afternoon.
Good afternoon.
I know you've made your way through into the studio after a very busy week. And today we've got another exciting topic to talk about. It's an interesting one because it's something people often don't think about very much.
Yes.
How much life cover do I need to have in my super? Because people think that their insurance and their super are two different things, but often super funds actually offer you coverage in your fund.
That's exactly right. And this one's quite topical at the moment because we've had a number of scenarios this week, and I just want to sort of demystify a few things here because you can hold life cover in your own name and you can hold life cover through your super fund. As you say, some super funds will give it to you automatically, and that's referred to as group cover where there's no medical underwriting. But there's a few tips and traps that people need to keep in mind because having it in there can be wonderful and having it in there can be really dangerous because people make an assumption that the outcome is the same regardless of how you structure your cover. And all we want to break down today is it's not. And we've got a few key things that people need to keep in mind when it comes to thinking about, well, do I have it in super or do I have it outside? Because the primary objective of any form of cover is the peace of mind for your family and loved ones, be it spouse, be it children, to generally eradicate debt, pay off mortgages, pay off investment properties, or to create a capital sum of money that could be used to generate ongoing income for the family where one income has been lost through something horrible. So that's the general premise of people maintaining life cover, which everybody's comfortable with conceptually. But when it comes to holding cover through superannuation, what we need to keep in mind is the benefits of holding it through super include you don't have to fund the premium yourself out of personal cash flow, which is generally great. People prefer that because they may be paying school fees or mortgages or whatever it may be. So you can fund the premium out of your accumulated super. The premium inside of superannuation is tax deductible to the fund at the fund rate of 15%. The other thing that you can do that a lot of people miss is you could have your invested superannuation with one fund and you could have your insurance policy in another fund or in a fund provided by the insurance issuer. So let's pick a company, MetLife. So you can go to MetLife and say, I want $1 million life insurance in the superannuation environment, and they will create a policy that is within superannuation that holds just your $1 million. You can't add money to it from an investment perspective. It simply holds your policy. Now, the big advantage of that is you could go over to your invested super fund, wherever it may be, and you can say to them, hey, Mr. or Mrs. Super Fund, can you pay $2,000 over to MetLife, please, as a rollover because the policy is held in the superannuation world. So I find a lot of people come in and go, well, I'm with this super fund, I have to have insurance with them. And the answer is no, you don't. Because different super providers will have different options in relation to the cover that can be taken out within their fund. The nice thing about having independent insurance is that you're then not tied to that particular superannuation fund for your investments. If you don't like them or your needs change, you can roll over your benefits. And all you do is tell the new fund to pay your premium over here because it's in the superannuation environment. So that one I find is lost on a lot of people because they think it's either their superannuation investment account or nothing, and it's not. Another big thing that people need to keep in mind is if you're going to take out something on the television and they say it's easy and it's wonderful, it's generally underwritten medically at the time of claim. Now that can be really, really dangerous because you could have a pre-existing condition that they don't know about because they haven't asked about it. You could pay a premium for an extended period of time, then go to claim and they say, oh, sorry, you've already had 2 heart attacks. And you wouldn't have got the cover to start with had you medically underwritten your application at the time you took the policy out. So I'm a big advocate of going through the hoops and jumping over the hurdles at the time of application so that you know in the event of a claim there are no surprises or disappointments where somebody doesn't get paid for something that they don't know that they didn't have or didn't need to tell somebody.
it does become something of a confusing environment in that respect, doesn't it?
Yeah, very much so. And I think, again, this is one of the times where we don't want to make assumptions. Another big one that I want people to understand is you really need to understand where your money's going to go out of superannuation. So you might have $500,000 of superannuation investments in your fund, and you might have $1 million of life insurance through your fund. Now, where your money is paid in the event of your death is critical to the tax outcome of the money in your fund. Now, we know that if we pay money to a spouse is a dependent under super law and tax law. Adult kids are not dependents under tax law. Why is that a problem? If I have $1 million of insurance and it gets paid to my wife, she gets $1 million. If I have $1 million and it's paid to a 10-year-old child, that 10-year-old child gets $1 million. If I have $1 million policy paid to a 29-year-old daughter who's financially independent, she incurs a 32% tax liability on that $1 million. So she's going to get 700 and a bit. Now, that's a $300,000 difference that people may or may not be aware of could occur depending on who the nominated beneficiaries are in your super fund. So to combat that, you might in that situation sit down and say, I'm going to take out $1 million of cover. Where am I going to hold it? It's for a minor. It's for my family. It's for my spouse. Okay, I can have it through super. I need $1 million for my 30-year-old daughter. You might hold that insurance outside of super because it's paid to her on a tax-free basis outside of super, or gross up the benefit, have 1.3 million of cover, knowing that you're going to lose about 300,000 in the event of a claim to get her the net million. So again, people just need to think about where it's going to end and whose hands it's going to be in, because that will have a direct impact on the tax implications of the benefit paid.
That is also confusing. So what you're telling me is that the payout from the insurance company is tax-free if it's in your own name, but it's not tax-free if it's been held in your super fund. Why is that?
And it's paid to a non-dependent child.
Yes.
Yeah, so anybody over 18 not studying that we deemed independent from a tax perspective, the superannuation fund is obliged to pay 32% tax because it's treated or deemed an unfunded benefit when it leaves the superannuation environment. So the necessary tax implications are incurred. So the structure here is really important, and I want people to be aware of that, because there would be nothing more frustrating than having cover through super and saying, oh, well, I'm getting a 15% tax deduction. That's great. Not understanding that if it's going to an adult child, you're going to lose 32%. Now, I can assure you the tax paid on the benefit received is going to outweigh the deduction claimed in the super fund by a massive margin. So don't assume that it's the same for everybody. And a lot of people do, or they don't understand the nomination they've made in their fund, which can have dire tax consequences by sheer accident.
Now, of course, the other trap that immediately occurs to me is that you might set up your life cover inside your super fund because all your kids are under the age of 18 and you think you're covered, everything's great. But then time goes by and you might set and forget, and then all of a sudden your kids might be grown-ups, they might be financially independent, but you still haven't changed your arrangements.
Exactly right. And that's where I say to people, this is a living, breathing thing. What you needed 15 years ago may not be what you need 5 years later, may not be what you need 2 years later. So it pays to check and just review your situation, because if you took $800,000 of life cover out to cover your mortgage and you've paid your house off, you could be paying premium for cover that you're not getting a lot of value from. So I'm always a big advocate of people reviewing their situation and not just assuming that because I did it a while ago, it's still relevant. It's about keeping it as current as possible, so that you're not either spending money that you don't need, or you could reallocate that money inside of superannuation or to other investments and continue to see the value of your super grow. But it's really important that people understand that they know where it's going to get paid, they have the necessary nomination in place, they understand where the money will end up and whose hands it will be in, and what is the tax status of that beneficiary. And then obviously the segue off the back of the insurance is, do I have the necessary estate planning documentation in place? Do I have a testamentary trust in our will? And we've touched on that in previous shows as a wonderful vehicle that can provide a lot of asset protection and tax control or minimisation. So check your insurance. then check your estate planning, because I think they sort of go hand in glove.
Yes.
Because they're very much intertwined with the outcome of the primary objective of taking the cover in the first place.
I know from previous conversations that the contents of your super fund are not subject to your will.
Correct.
So it's important that when you have a super fund, and I presume that includes the insurance inside the super fund, you need to nominate a beneficiary.
And that's right. And that's when we start talking about, do we have a binding death nomination? Do we have a non-binding nomination? And that's where, again, good estate planning advice from a solicitor can ensure that there are no surprises, or the assumption that, oh, well, I've got that. And I had a few of that this week. Yeah, I've got one of those. And then you get the statement open and it says, we are not bound by your nomination, which says that the binding nomination has lapsed or it's been changed. But again, a lot of people go, yeah, I've got one of those. It always gets a little bit curly when the nomination is to somebody that's not their spouse.
Right.
And they're both sitting across the table from me. That one's always a little bit curly to explain. But I generally stay out of those ones.
Well, that raises a question for me, because obviously if you only have super in your super fund, you need to make a nomination for where that super goes should you pass away.
Correct.
But if you have life insurance cover in your super fund as well, that's effectively two different pools of money, isn't it? Do they have to have the same person as the nominated beneficiary?
No, you don't. You can have any nominated person that is eligible to be that type of nominee. But in the event of a claim, the insurance provider would put the cash into the fund. So you would end up with one pool of money that would then be directed by the nomination that you've made.
Right.
But you can have a number of different nominations for a number of different reasons. And again, this is why good family law advice and estate planning advice is vital, because we've just addressed a potential tax issue that people may not be aware of, because they always assume, oh, well, it comes out, it's tax-free. Well, not necessarily. And where that would occur, it would be extremely frustrating to see that amount of money be taken in tax unknowingly, because you assume that it was paid out tax-free to your kids when your child ceases to be a dependent under tax law.
Now, here's another question for you. Does this have to be an either-or situation, or can you have life cover both in your super and outside your super as well?
100%. Nothing says that it has to be in super. It's just one way of doing it. And a lot of people like it because of those factors we talked about at the start. You don't have to fund it. It comes out of super and it's tax deductible. You could have a policy in your own name for certain objectives. You could have some cover through super for certain objectives. And that happens a lot when people have specific targeted amounts for certain projected outcomes. You really need to think, why am I doing it? Where am I doing it? And then what are the tax implications? And then you can have the best of both worlds. It's just inside super's one option. It's not the only option.
So you can nominate your super to be delivered to your spouse in the event of your untimely demise, but if you want to provide some economic and financial security for another favourite person, perhaps you need a separate insurance policy to cover that.
Exactly right. Then you've got everybody happy and everybody covered and unnecessary tax avoided right out of the gates.
Yes, and leave the disputes to those who have been left behind. Something like that. Well, it's a lawyer's picnic, isn't it, when you start doing things like that?
Then you're probably going to need to gross up the insurance to pay the legal bills.
A little bit more might be necessary. Luke Smith from Envision Financial is with me in the studio today, and we're talking about how much life cover should I have in my super fund. You don't necessarily have to have any, but it's a choice that's available to you. And what choice you make might depend on your particular individual circumstances. We'll be back with more in just a moment. Luke Smith from Envision Financial is with me in the studio today, and we're asking the question, how much life cover do I need to have in my super fund? And, well, the answer so far seems to have been, it's up to you.
Exactly right. And I think what we want people to take from today is through super is just one way of holding it. You can hold it in your own name. You can hold it in super. You can pay for the premium out of your accumulated super balance if you don't want the personal cash flow. You can even have a policy through superannuation and pay for it personally, and then you claim a tax deduction as a contribution, which soaks up some of your $30,000 concessional limit. So there's loads of ways to do it. And I think all we want to try and demystify today is that there are a number of options, there are a number of ways to structure things, and there are certain implications that people need to keep in mind. Generally speaking, outside of super, tax-free payment. Generally speaking, tax-free payment inside of super to a dependent, and a taxable benefit to a non-dependent for tax purposes, which could be an adult child. So think about the purpose of the cover. Think about how much cover you need. Then think about where is the best place to hold it, thinking about the recipient and the tax implications before you leap to, well, I'll do it there because I get a tax deduction, because you may inadvertently result in a much higher tax bill for the recipient than the deduction that you've got through super. So I think it's important to keep things relevant. I think it's important to keep things accurate. And I also think it's very important, if you are going to choose to have cover through super, that you have the necessary nominations in the fund so that you address the transfer of the money and the control through a binding death nomination if that's applicable. And I think if you're going to go down this road, a well-structured will is going to be very, very valuable for your broader situation, because it's one thing to generate the money for certain purposes. It's another thing to maintain control and protect it for the recipient of the money in some situations. So I think holistically, the estate side and the structuring of the cover go hand in hand. And I think if you're prepared and you're organised, you'll get the best outcome possible.
It seems to me, from what you've told me today, that really the most critical question that you need to consider when making this choice is ultimately, who do you want to be the beneficiary of the money? Is it a dependent or is it somebody else? And that's going to really influence your choice.
Exactly right. That's your starting point. Why am I doing this? I'm doing it for that purpose or that purpose. That then leads you to, now where do I structure it? Because where it lands, as you've said, where it lands is the key contributor to the tax outcome and the control. And then you can worry about, well, how much and how do I pay for it? But you need to start with who's going to get it. Then you can decide how much they get, and so on and so on. So I think that's a really good way of coming at it.
Yeah, that's the important point to remember. And of course, in some circumstances, it might be appropriate to have a bet each way. Have two
100%.
different policies, one in the super and one in your own name.
Exactly, because we've got to think, what's the tax implications for the person getting it? If they're a non-dependent, hold it outside. It'll be a lot cheaper. Forego the deduction for a massive tax bill. If it's going to a dependent for tax purposes, keeping it in super will ensure that it's paid tax-free and you can get a deduction along the way. And if you need a foot in each camp, happy days.
Yeah, and it's simple enough to do. So at this point of the program, Luke, I have to ask you, where can listeners get more information?
Yeah, so office number 62604749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify, and we've got YouTube channel Envision Financial Canberra, where we've got a backlog of all of our shows for quite a, and we've got quite a library going there now. And we've got Smart Money Strategy, your ultimate guide to financial planning, where there's a whole chapter on the structure and flexibilities of necessary insurances.
Fantastic. Thanks very much.
See you next week.
Luke Smith from Envision Financial, and Luke will be back with us once again at the same time next Friday afternoon between 4:30 and 5, right here on 2CC.